Zoltan's latest dire warning, and this is when silver and gold take off.
And late last week, Zoltan Pozsar was back at it again with his latest piece entitled Ride of the Valkyries. Bit of a play on the Valkyrie there and Paul Volcker and volatility. Now, I'll put a link in the description below to his full piece. You can read it in your own time, read the full thing, but just want to highlight a few things here. He says that the Fed will have to shock markets to achieve the desired response. That is, it will have to inflict more losses on stock and bond investors than it has so far. That wasn't clear enough. The former vice chair of the FOMC closed by saying, one way or another, to get inflation under control, the Fed will need to push bond yields higher and stock prices lower. He says there can be a recession precisely because balance sheets are so strong. He says balance sheets mean the Fed needs to lean against the wind harder to shock demand. Strong balance sheets are a cyclical bad, not a cyclical good. Means more discipline from the Fed, more hikes and more volatility injected by the Fed by design until financial conditions tighten more and demand slows enough. The Fed, he says, has two options. It can talk tough or it can actively do quantitative tightening. And he goes on to say where Daly wants to see more tightening of financial conditions. He says volatility is the best policeman of risk assets. So he goes on and says this uncertainty is flooding volatility and a sell-off in equities and crypto assets, and that is a good thing from the perspective of a Fed that wants to see financial conditions tighten. He says our message today is consider the possibility that the Fed, on a singular mission to slay inflation, won't rest in its pursuit of tighter financial conditions until yields shift higher, stocks fall more, and housing turns as well. The Fed is pursuing demand destruction through the negative wealth effect. Once again, strong private balance sheets raise the risk of a recession, for they may force the Fed's hand to shock risk assets more to make sure we get a recession, or at least a very hard landing, so that the Fed can slow down inflation enough. And then down here, rallies could beget more forceful pushback from the Fed. And then just in the last paragraph here, stocks, of course, are not the only egg in the proverbial wealth basket. Housing and crypto assets are in the basket too. Wealth declines there should determine how much damage will need to be done to stocks. No, we are not saying the Fed should generate a market crash, but rather an engineered market correction. Zoltan calls it the Fed call. That's meaningful enough. So not the Fed put anymore, the Fed call. We think some version of our extreme parable will come to pass this year, and that rates and risk markets need to get ready for the ride of the Valkyries. In this dance, the Fed leads the market. It does not follow it. It cannot by definition. That is a Volcker moment in and of itself. A Fed that is riding a call option of the stock market needs to see a deeper correction big enough to slow demand and push unemployment higher. We have never achieved a soft landing, so let's not pretend that the fastest pace of hikes in a generation and an unprecedented shrinkage of the balance sheet will yield one. Now, for those of you that follow this channel, won't be surprised to hear any of this from Zoltan. We've been talking about this for some time now, and I did this video, Don't Fight the Fed, where I shared exactly what Bill Dudley had to say in that interview. I shared in here, what Jim Bianco had to say. And with that, let's actually jump over to Twitter and have a look at what Jim Bianco is saying right now. And this from Jim Bianco. Powell gave a radio interview Thursday after the close. In it, he said that 75 is on the table. That's 75 basis points, which apparently he ruled out. Hard landing out of his control. So, yes, hard landing coming. Demand is out of whack. Get ready for big hikes coming. Warned of pain coming. Dissembled when asked if they blew it with transitory. He said yes. And this also from Jim Bianco. Statement from POTUS in the last 5 minutes. So this is last week. Headlines, Biden says inflation remains unacceptably high. Biden, confident Fed will do its job on inflation. It is all on Jay's shoulders, and Jay only has one tool, wreck the stock market to create a reverse wealth effect. Just as Zoltan is talking about, just as we've been talking about on this channel, and I've been talking about this over and over again, that this is now political. So Biden, he's putting, it's hurting him politically. He's putting it on the Fed. And countries around the world are doing the same thing. When it hurts politicians, inflation hurts politicians because it hurts the majority of voters. They put the blame back on the central bank. And Goldman Sachs is warning companies and consumers to prepare for a recession. And final comment on Zoltan's latest note here from Luke Groman. He says, left unsaid by Zoltan's latest note and Dudley's comments in April is that the Fed targeting stock price to tighten financial conditions is a tacit admission of a point FFTT, and for those who don't know, FFTT is Luke Groman's firm, has been making for years. At 200% of GDP, US equity market effectively is the economy. And that's something we've been arguing for a long time, is the economy. It's not about now saving, investing, producing, creating real wealth. It's been financialized, and it's all about asset prices, the wealth effect. The question is that now going to be chucked into reverse? And from the St. Louis Fed President Jim Bullard told Yahoo Finance that he thinks the Fed will have to go above neutral on the policy rate by the end of the year to put downward pressure on the persistent component of inflation. This is the big problem, is the Fed cannot print commodities. They cannot print goods. And the only thing they have is to raise rates, create a recession, put people out of work, to bring demand down to the level of goods and services in the economy. They cannot print more. They cannot create any goods and services. They can only destroy demand, and that's what I believe is about to happen. And this here is from Greg Epp, the chief economics commentator for the Wall Street Journal. He writes, indeed, annual wage growth has accelerated from about 3.5% before the pandemic to between 5 and 6%. That is consistent with inflation of 4% if productivity maintains its recent tepid pace, or 3% if productivity perks up. For the Fed to feel confident inflation is headed below 3%, it needs to see lower wage growth, which generally requires slower economic growth and higher unemployment, and it will keep raising interest rates until those things happen. That means more carnage in the stock market. Well, that's a feature, not a bug. And have a look at this chart of margin debt. Go back in time, look at the S&P 500. Look at what happened with margin debt there. Look at what happened, margin debt in February 2009. And then February 2016, December 2018, obviously March 2020. And now, check this out, the end of April, look at where that peaked and where it's at in such a short period of time. And because I'm the bearer of bad news, why not give you this as well? India bans wheat exports to try and tame prices as a scorching heat wave curtailed output. So India prohibited wheat exports that the world was counting on to alleviate supply constraints sparked by, you know what? The government is committed to ensure the country's food security. The Directorate General of Foreign Trade said in a notification dated May 13, India will still permit exports on the request of other countries, it said. Shipments with irrevocable letters of credit that have already been issued will still be allowed, the notification said. The reason why I'm sharing this with you is because of some things happening around the world. We are seeing critical commodities that we are struggling to get our hands on. In particular, things that make food. And we're already seeing several countries, Peru, Sri Lanka, others that are really, really struggling. In fact, on the verge of collapse. We're seeing some Asian countries also not exporting certain commodities, more in that agricultural sector. And if more and more countries do this, my fear is that that food shortage that I've been warning about for some time is just around the corner and will get worse. This could get very nasty. So when will silver and gold take off? Now, I know I've shared this chart in a couple of recent videos now, and I'm going to do it again, and I'm going to do it again and again and again. The Exter's Pyramid. Now, what are we seeing at the moment? We're seeing a run to the US dollar, a run to cash. There is confidence issues happening at the moment. We're yet to see a full monetary or banking crisis, but we are seeing a confidence issue. Now, Exter says that, at a later stage, this scramble will continue into gold and silver. And in a second, I'll read you a letter from Don Durrett from goldstockdata.com about this. But I'll tell you what I think. This is Steve's opinion. So yes, central banks are going to raise rates. They're probably going to raise them a lot higher than any of us thought. And remember, I was in the Luke Groman camp that they're only going to raise rates a couple of times. And, they had backed themselves into a corner, and they'll do a power pivot. However, I now see the political side of it. And I think they will raise rates higher than I originally thought. And we will see asset prices fall, very similar to 1973, 74, which I keep arguing about. But these central banks, what they want, and there's a key thing that Zoltan said was he's not arguing for a full-on market crash, which could lead to issues with financial stability, banks possibly going under, and then credit markets freezing up. No. He used the word engineered market correction to destroy demand, to bring that down to basically where the supply of goods and services are, to reduce that CPI number, because it is becoming a political issue. Good luck to them. I think they're going to screw it up. And I do think we could see some financial instability issues. But at some point, and I don't know where that point is. I don't know where, I thought that they might try to get to 1.25, maybe 1.5%, and then that's it. And then they'll have to do a power pivot. Oh, you keep using that term, power pivot. Now I think they'll go higher. I think they'll go to 2.5. They may even try to push 3 or 3.5. Personally, I think they'll break the markets well and truly before then, but they'll continue doing it until the point of credit markets freezing up, until there becomes an issue with banks remaining viable. They don't want to see banks going under. And at some point, they are going to stop raising rates. because sovereigns are going to be in a lot of trouble. And at some point, they are going to do a power pivot. And they are going to cut rates right back to zero. In fact, negative. And here in Australia, some years ago, I remember APRA, which is our prudential regulator, told the banks to prepare and get ready for negative rates. Not negative real rates, negative nominal rates. It's not like, we've seen how good that works in Europe and Japan, right? Yeah, right. But that's what's going to happen. And there's going to be all sorts of programs, UBI, like they're going to spend like crazy. QE is coming in a way that we haven't even seen it so far. And at that point, everyone's going to want to hold gold and silver. And there's going to be a huge rush into the metals at that point. When that happens, is that months away? Is that years away? I don't know, but I'm very confident that that is going to happen. And so I use these smashdowns in price as a way to buy more, especially in the mining sector. I mean, people are upset that gold and silver has come off the way they have. We've seen some explorers down 50%. We've seen some other stocks in that sector down more than 50%. Yet they're good companies. They have great assets and great management. A lot of these firms, like I'll give you, and I've shared some of these firms on this channel that I've talked about. And yes, I've trimmed profits. I've taken some of those profits before they fell. And guess what? I'm buying back into them. So that's when I think silver and gold take off. But we've got a lot of pain to come first. And that's why, I've shared on this channel that, Brent Johnson's dollar milkshake theory makes some sense. And you should have a portion of your portfolio in case that plays out. And it seems to be playing out at the moment. Whether it continues, I guess we'll wait and see. But let me just share with you guys this letter from Don from goldstockdata.com. All right, so here's Don. He says there's been a lot of precious metals mining investors complaining about this correction. Below is my reply. I've been through a few of them. 2008 was the worst. After that, corrections are just seen as temporary. This 20-month correction has been harsh, but nothing compared to 2008. So here's his letter. Here's his reply. Precious metals miners are speculation bets on a 5+ sigma event that causes investors to run to gold as a hedge. Many investors try to treat precious metals miners as opportunities to make money in the medium to near term. This is a mistake. You can only approach this with a long-term mindset. They're a lot like Bitcoin. You need to be a believer to hold precious metals miners for the long term. I'm only doing this, investing in precious metals miners and physical silver, because I believe strongly that the US financial system and bond market is fundamentally flawed. In brief, we don't generate enough wealth for the amount of debt we accumulate. This flaw will eventually manifest into a run to gold and silver. The question is when? Next month, next year, or in several years? I don't care. I'm willing to wait. While I'm waiting, I'll continue to buy dips and improve my portfolio. Those who are seeking annual returns will constantly get frustrated as they spin in place or lose money. Few smart traders will make money in the short term, but they are not the norm. But they are not. Anyway, it's Twitter. My expectation is that the US will lose its global dominant position. This will be a once-in-a-generation event, pushing gold to $3,000 or higher and silver to $100 or higher. In my opinion, $2,500 gold is way too conservative a target. Likewise, $75 silver is way too conservative a target for this event. When you use these targets, the miners are incredibly appealing. You just have the conviction and patience for that outcome to occur. Meanwhile, the trolls will make fun of us as we wait. Once gold gets over $2,200, silver gets over $30, a plethora of investors will chase the trend, creating a mania. That mania is likely to be generational. I want to be part of it. So I wait and add more stocks. I currently have over 150. My conviction has never been stronger. And in the future video, maybe later this week or early next week, I'm actually going to talk a little bit more on this and just what I discussed about the macro environment and how this is going to play out for gold and silver. And remember, I believe that we're going to see a 1973-74 style event in asset prices. Well, what happened to gold in the second half and silver in the second half of the 1970s? And what happened to the miners and the explorers? Yeah. Anyway, guys, love to see your thoughts and opinions in the comments below. Do you guys think that Zoltan is right? Do you think the Fed and central banks are going to create asset price falls? Are they going to raise rates higher than we originally thought? And at what point do you see gold and silver taking off? Love to see your thoughts and opinions in the comments below on this one. If you like this video, please hit that like button. Really do appreciate it. Take care, guys, and I'll see you all again on another episode of Finance on Cart.